Brent Schutte, it may be the dog days of summer, but the market has been extremely active. So give me your outlook for U.S. stocks for the remainder of the year. Will this keep up?
Yes, so we came into 2015 with a range-bound, low return, but volatile type of year forecast. And that's what we've had so far. And we believe that will continue throughout the rest of the year because people are continuing to go back and forth on will the Fed tighten or won't the Fed tighten. When you look back historically, 1994, low return type of year. 2004, 2005, the last time the Fed hiked, low return type of year. And so as long as we're hanging on every single word by New York Fed President Bill Dudley or Atlanta Fed President Dennis Lockhart, you're going to have these backs and forths on a daily basis. And right now, that's what you're having and what you should expect to continue to happen.
In your view, does the market reflect, when it comes to valuation, what's going on in the economy?
You could probably answer that a couple different ways. One, I'll tell you from an earnings perspective. So if you look at the price to earnings multiple on the S&P 500, it's currently somewhere around 18.2 times. People will correctly point out that if you look at a long history, 16.6 is the average. But that average is made over a lot of different interest rate cycles. If you look in inflation cycles, and so if you look back historically, when inflation is between 1% and 2%, the average is 18 point something times, which is where you're at right now. So from the standpoint of price to earnings, yes, the market probably reflects somewhat of the low interest rate economy. I think the second way to answer it would be that the market probably has gotten a little bit ahead of the economy. And right now, part of the low return type of year that we're looking for was that the economy has to catch up to the market. And so that's what you're seeing right now is that the economy is kind of catching up to the market, and that's why the market's going to trend sideways for a while.
All right, well, folks who've invested in Europe and Japan, they've had a pretty good year. Both regions have outperformed the U.S. year to date. Will they keep it up?
So we just spent a lot of time talking about the Fed. When you go over to Europe, you don't have to talk about what the ECB is going to do. They've told you they're going to backstop the market till September of 2016. And so if you look at the economic cycle in Europe, it's a lot further ahead. So they clearly have a bigger output gap to fill. If you look at valuation in Europe, people will correctly point out that on a trailing earnings basis, Europe doesn't look that cheap to its history, but you have to remember that places like France, Italy, and Spain, those big economies in Europe, their earnings are somewhere 60 to 70% off their peak, where in the US we're at new peaks. And so we add the economy, the policy, and the valuation together, and we continue to believe that Europe, and for that matter, Japan, will outperform the US for the rest of the year.
All right, now let's talk about emerging markets. Clearly there's problems in China. People are worried about slow growth. The government is trying to prop up the stock market. They're forcing some trading restrictions. So what do you do with emerging markets and really China right now?
So emerging markets broad, we do continue to hold a position, and that's largely because of valuation. If you look at the valuation of EM stocks, they look relatively cheap. That being said, what usually happens, and maybe that's what you're getting right now, if you look back to 2004, for example, the last time the Fed tightened policy, everyone, when the Fed tightens, people run out of EM. People remember back what happened in 1998, and they extrapolate that into the future. And so in 2004, the Fed went to hike rates. EM fell by 20%. But then it rallied back and moved ahead of that in a couple of short months after that when nothing broke. And perhaps you're in that sort of period right now where people are extrapolating out some wild currency move that may or may not happen. And so we are neutral weight emerging, largely because of valuation. At some point in the future, we expect those economies to turn. Coincidentally, most EM economies have been loosening policy over the last couple of years, and that may begin to filter into their economy.
And then finally, there's been a few worries stated in the market about high yield. So are you worried about high yield? What's your view right now?
Sure. So we still do have a position in high yield, but it's mainly more towards the bank loan side of the equation. Typically, bank loans are higher recovery rates, so if something goes bad, you typically get your money back, so the recovery rates are typically 80 to 90%, whereas in high yield, if there's a bankruptcy, you get 30 to 40%. Also, as most people have learned, the coupon in floating rates is floating, and I believe there's less exposure to the oil industry, which is where most of the pain in the high yield bond industry is occurring. So yes, we continue to own high yield, but more so in the form of bank loans, which are somewhat different, but then often lumped in with that asset class.
All right, well, thanks a lot, Brent.
Thank you.
And thank you for watching The Street.